Well, if you're an owner in the middle of a project, or if you're an owner considering a project, some of the biggest questions that you're probably asking yourself is, supply chain's already been rough, prices have already been high. How long is this going to continue to last? And how significantly is the war in Russia and Ukraine going to ultimately affect the possibilities of your project over the course of the next few quarters, maybe even the next year or two? This is another update for us to bring to you to help to understand supply chain, if it's loosening up, and how it might affect your projects. Welcome to the PioneerCast. I'm Dwayne Abels, founder and president of Pioneer IQ. I hope over the course of the next few minutes, you're able to capture some insights on how to prepare your leaders, how to scale and build your business, and some insights on how to predict, forecast, and change your markets. Today, we're going to cover this big topic of supply chain, when it loosens up, how it's going to affect you. We've had a lot of conversation around this over the course of the last several months. Here to help us again yet today is Keith Prather.
Hey, glad to be with you guys.
Well, Keith, thanks for joining us again. We've done several podcasts over the course of the last week and a half. Been getting a lot of feedback, a lot of questions. We sent out the interest rate podcast just a few days ago. First question back was, what about supply chain and material costs? So here we are. I think this might be our third or fourth PioneerCast just on this particular topic. So today, it sounds like we're going to do something a little different. We're going to get right to the data and help people start to understand what we see and why we think what we think as it pertains to supply chain, raw material costs, and how it's likely to affect projects in the short term.
Yeah, one of the things, Dwayne, that you and I do all the time when we're looking at business intelligence or corporate intelligence is we monitor data constantly. We watch it by the hour sometimes. And so what I thought would be fun to do today is just take people through a quick tour of what we do every morning when we wake up to kind of figure out what's happening with prices. So first thing we're going to do is, again, and all of this is in context of what has changed since the war started, and if anything, and where do we expect it to go. So the first piece of this is that kind of coming into the end of the year, just remember that the supply chain was still congested. We know that going into Q1, we were going to have the Chinese Lunar New Year. We were also going to have the Olympics on top of that, which means China basically shut down for nearly a month. We weren't getting a lot of supplies in and out of the country. You throw Omicron on top of that, and we had a lot of congestion. So a lot of that freight is now finally kind of clearing Asia, headed inbound into the United States, and then we'll be processing it. So we've kind of got that seasonal wave that was all taking place before the Ukraine war started. But typically in wartime, what would happen is that when you would see massive disruptions to, especially two large countries like these, Ukraine being about the size of Texas, and then obviously Russia being one of the largest countries in the world by size, that you would see some global ripples from supply chain disruptions, and we would see prices surge. So the punchline, we laugh and we call it bluff, right? Bottom line up front. The bluff here is that prices and the condition that you had just prior to Christmas and then coming into Q1 have not really dramatically changed since the war started. The war has not had that big of an impact on transportation and the global supply chain yet. So what you're staring at on the screen here are maritime prices. So this will be the cost to move a container between different markets around the world. And what you can see is that we hit a little bit of a spike last year, and this happens to be the bulk commodity index, which is what you guys would focus on. It's the movement of steel and aluminum and copper and all those construction materials that we typically want to pay attention to. And we were about $11,000 a container in September of last year, which is really our peak. Then we kind of bounced around. Prices really did not come back down that much, and we're still sitting right now right at about $9,000 a container. Seasonally, we would expect a little bit of a dip coming out of Christmas. So this is right in line with where the global economic trends were sending us. Has nothing to do with the Ukraine war. Now, it's still incredibly high, right? So that's the bad story. If you look at where we were prior to the pandemic, it was costing you about $1,300 to move that same container. So now today, again, you're up around almost $10,000 in container. So you're not getting any relief, at least on that front. Some of the only places where we've seen a little bit of additional congestion, like if you look at this little chart over here, between China and East Asia into the Mediterranean, up into that area, up into the European area, you do start to see some price spikes. And we are starting to see increases in prices moving goods in and out of Europe. And so that's a little bit of a concern, because eventually that would have a little bit of a ripple. At least that's what one would think. We're starting to pick up anecdotes, Dwayne, that talk about the fact that if I can't ship goods like into Europe, or if I can't get them into parts of Russia, that capacity frees up, and that capacity goes somewhere. There's business to be had out in the world. And so if you're a maritime owner and you've got a container ship and you were sailing it between Shanghai and like a port in Crimea, and now if you can't move through the Black Sea, what do you do with that ship? Well, you don't park it. What you do is you redeploy it. So now all of a sudden we've got all this spare capacity that's starting to get redeployed to Asia, moving goods from Asia to the United States. And so we think what that will do is help push some of these prices actually down. So your actually transportation costs for importing and inbounding goods looks like between now and the end of the year, you're going to be seeing a down cycle. It's going to be trending downward. Again, depending on how the war goes. And what I didn't say up front, you and I talked about off camera, was just that we are still in the fog of war, and anything can happen, right? I was watching the stock market the other day, and in the matter of literally 20 minutes, oil went from 130 a barrel to 120 a barrel, and then we ended the day at 123. Today, oil prices, I'll just jump over there real fast because that's one of the big areas that we watch. Oil prices today are about 105, right? So, prior, if you take a look all the way through prior to the beginning of the year, we were hovering right around 80 bucks. It was already starting to go up, but then we kind of get into wartime up here, and that's when you get the super surge. So prices were already heading up, but now we get the little super surge, and now they're kind of settling back down as supply chain managers kind of figure out that maybe the oil shock isn't as bad as they thought it was. We do know that Russian oil is leaking onto the market through China, through Iran, through some other countries. So they're thinking that maybe the global congestion, the global challenge, the global crunch on oil supplies may not be as bad as they thought at first. Now, again, we're still in the fog of war, and at any one time, there could be an event that sucks NATO in, and these prices go to 150 overnight. So we've got to watch that. But right now, it looks like the fundamentals kind of keep us down in this range. I did go out and I did look at the EIA's forecast for oil prices through the full year. And with the EIA has us basically hovering around 110 for the year. And I'll just throw this in real quick. I've got a lot of CEOs, you and I both do, asking us, at what point in time does this inflationary pressure push us into recession? And so we went back to time, and we went back to a period really between 2010 and 2014. And that's when we had a combination of oil prices over $100, excuse me, and we had food prices that were also surging. And at that time, what we saw was that GDP lost about 0.5 of a point. So we were growing at about 2.5% a year. And in those years when those price pressures were the hardest, we didn't go into recession, but we dropped back to about 1.8%, right? We were barely keeping pace with, at that time, inflation. So the risk now is that we would slow down as an economy. The economy might, lose another couple points of growth. And so instead of growing at 2.5 or 3%, we grow closer to 2%. And then you throw an inflationary rate of 7 or 8% on top of that. And that's not a good formula. That's what we call a stagflation formula. And that would be the big risk if oil prices stay high. But back to the supply chain, and this, I know this is part of it because you're all paying fuel surcharges. But let's go ahead and look at the other two modes that we're concerned about. One is looking at rail traffic, because once we get things off ships, they got to be able to move inland domestically across the U.S. And what we're looking for is some kind of trends here. So this is total carload activity for basically for the rail sector. Sorry, it just updated and bounced and I lost it. So total carload activity, you can see that it's up, right? So we're up 2022 over where we were last year and where we were the year before. So not by a lot, but it is up a little bit. So trying to figure out what that actually is, when you look at intermodal movements, so this is containers coming off the rails, or I'm sorry, off ships, being moved around the country as intermodal containers. We're actually trending below where we were last year, Dwayne. We don't have as many containers moving, and so some of that could be the impact of just some of the supply chain smoothing out. We do know that ports around the country, other than the LA basin, are kind of telling us they're back in cycle, that their congestion and their backlogs are not that dramatic. So freight is flowing a little more fluidly than it was like last fall. There is still a little bit of a backlog at LA and Long Beach, so there is a delay getting cargo in. But the last data I've looked at shows that that delay has been really improved, kind of coming into the second quarter. And the one thing to watch, and I'm bouncing things around at you here, but there's a lot of moving parts right now. And the one thing to watch is that we do have a longshore contract negotiation that starts, I believe, in May. And last 2 or 3 contract negotiations have not gone all that well. And this year, the union has a lot of power. And depending on how they want to treat the supply chain situation and the war in Ukraine and kind of the fact that it's kind of a national crisis moment, will kind of determine whether we get a quick contract or whether this thing drags out.
Mm-hmm.
So a lot of activity here. I mean, one of the things that we watch in construction is we watch metallic ores and minerals, and at least we do see movement at about the same rate as we had the last 2 years, maybe a little bit elevated. So that's good. Forest products is the same thing as they call lumber. So you're seeing lumber moving, but not at the rate it was last year. So there's a lot of recovery happening last year as lumber was coming back on the market. This year down a little bit, but not tremendously, not bad. And then the last thing, non-metallic minerals, this is going to be like gypsum and gypsum board and some of that. You can see that those shipments are way up. So there is a lot more of that cargo moving around the country, and that demand is higher. So then the last one we wanted to cover real quickly with folks is just what's happening in trucking. And I like this because this gives us a weekly barometer for what's happening in the trucking industry. And we do look at this. It's a little bit hard to. I'll just try to decipher it for you a little bit. What we're looking at here is in the spot market. We call this is really like load demand. So this is demand for trucking services, and they were up still 24% year over year in February. But that was down, is decelerating a little bit between January and February. So we saw a little bit of deceleration coming out at the beginning of the year into February. Typically, I would tell you that's going the other direction. So there's a little bit of something happening in the marketplace where demand was down. As a result of that, that number below this is capacity. So the number of available trucks actually improved by 4%. What they use this thing called the van load to truck ratio. So we don't know what the volume of posts are. We don't know what the volume of trucks are necessarily, but when we take those two and we create a ratio out of it, what we come up with is this thing called the load to truck ratio. And it just very simply means the number of loads for every available truck. And that kind of gives us an idea of whether we're still on a price pressure moment or whether we're seeing capacity ease and trucks are more available and so prices will come down. And what you see here is that the van load to truck ratio, we saw almost a 3% drop in the number of loads for every available truck year over year. But look at it month over month. In February, we saw a 22% drop in the number of loads for every available truck from January. So that's pretty significant.
We like that number, right, Keith?
Yeah, it's going the right way. And actually, prices are still so high that it still works for the trucking industry. The trucking industry can see this come down quite a bit before they start to feel economic pressure. But this is good. It's also good for those who are out there trying to hire anyone that drives with a CDL, because as that capacity loosens up a little bit, those drivers are more easily recruited out of over the road and into more construction like CDL jobs. So that's not too bad. It's good. It's a good story. What you see on the rate side, though, it's what we're looking at, is about 28% increase still, 28% higher this year than we were last year on the spot rates. But then just a tiny little bit, not enough, but a tiny little bit of deceleration month over month in between January and February. These others I won't pay too much attention to. The only other thing I would throw in is note that right now with fuel prices the way they are, you're still paying about a 41% fuel surcharge on top of your shipping. So still pretty significant. So just want to show you one more page. Here's where we have to do that little filler because Keith's computer is so slow. But anyway. So this is the national map. So depending on where a construction firm is sitting, this will help them understand where capacity is the tightest. So when you're like, let's take Texas. Right now, Texas, the load to truck ratio is at its highest level. So we've got 5.5 or more loads for every available truck in the state of Texas. And so trucking and shipping conditions, prices in that market are still going to be super high. But you look at like Florida, and Florida's kind of a funny market. We call it in trucking the black hole, because there's a lot that goes in, nothing comes out, right? So we have a ton of freight inbound, no freight outbound. But there's a lot of available trucks, at least in Florida right now. We also see a lot of available trucks in California, surprisingly. even more when you step up into Oregon, and then a little tighter market in Washington. But you can kind of see just this loosening up, especially west of the Rockies, and then tightness all the way up and down the East Coast, and then still in the South. So it is interesting. We do get a comparison year over year. You can kind of see that the load to truck ratio through the end of February was about 7 loads for every truck on a national basis. So last year was almost exactly the same number. So we were trending right in line with 21. 22, right before the pandemic hit, we were about 1.8. So that tells you a little more what a normal seasonal change would look like. So this year we saw a more dramatic drop, but wow, we're still elevated. So the trucking market is still incredibly tight, and this is the one metric that tells you that it is. Lastly, we can kind of get rates all the way up through March, and you can see a little bit of slowing still. Some of this is weather related. We've got a lot of winter storms kind of hitting the marketplace, but we're right at that 6 loads for every available truck ratio number. So that's just what I wanted to show folks. I mean, this doesn't help things like nickel prices. We had a situation where a lot of some of the raw materials that go into producing stainless steel, like nickel, come out of Russia. And even though Russia only accounts for about 3% of the world market, they are seeing some major disruptions between Russia and Ukraine in the movement of some of those metals. And what's happened is buyers around the world have gone in and they've started trying to buy up materials wherever they can find them. So you've got Chinese buyers who may have been buying Russian nickel, who are now scrambling around the world and competing against other buyers to find nickel. And so, and they're buying more than they should be, so they're hoarding a little bit. And so that's why you get the surge in nickel prices. I will say this: you guys probably saw in the news that that nickel went from $20,000 a ton to $100,000 a ton in an hour. And the reason why that happened was because there was a Chinese trader, a broker, who had shorted nickel prices. So they had sold nickel prices, at a level that they thought, they could. Anyway, they shorted the market. I'm not going to explain it well, so I'm not going to try. But they shorted the market, and then they had a margin call. So the marketplace came in and said, you've got to close your position. In order to close your position, you've got to come up with a certain amount of cash to be able to do that. And as they started to close that position, the price started getting bought up. And so other brokers would jump in when they saw the price jumping up, and it elevated. And again, went from 20,000 a ton to 100,000 a ton. And then it started to come back down a little bit, but it hasn't come back down the way we thought it would. So there's still some pressure in that raw material, raw metal commodity market that hasn't come off since the war started. So that in addition to oil prices, and then lastly, food prices, which indirectly impacts the construction sector. Those are really the 3 things right now coming out of what's happening with the war in Ukraine. I mean, I think the bottom line is that the supply chain should start to smooth out. The unknowns are what happens to oil prices, and do they go high enough that it throws us into a little bit of economic decline? And then as we see that part of Europe kind of get cut off, does that free up enough resources around the world that we do see some significant improvements in availability of products and materials, in other sectors? So still a lot of moving parts. If we were to do this video Monday, who knows, the story may have changed. It's just such a volatile time that it's just really tough to be able to stick a flag in the ground and say, here's exactly where we're headed. Let's go hike that way, right? It's a little bit difficult to make that statement. So see what happens. Generally, the shock and awe of the start of the war and the fact that there is a war and that it's devastating and terrible, and the scenes we see on TV are horrible. But we're kind of, unfortunately, I guess, for the Ukrainian people, kind of getting beyond that a little bit. We're kind of moving back to, okay, what does business as usual look like now? And you can kind of see things start to settle down just a little bit.
Well, it was good to see that 1/3 of the truck to load ratio is starting to make a big shift in the right direction. So I think, what was it, 2 months ago, it was nine loads per truck ratio. So wow, that's good news for truckers and people who need to get supplies to job sites.
That's right. Absolutely.
All right, Keith. Thank you so much. We'll probably do another one of these updates here in about a month or so. Lots of things are changing. Again, hopefully over the course of the last 10 minutes, you've been able to get something that helps you better prepare your leaders to help better serve your clients, predict some of these crazy supply chain issues and even cost. All of us continue to pray for what's going on there in Ukraine. Keith, thank you.
Thank you, guys. Thank you.